August 29, 2005. The Gulf Coast wakes to a storm so large, even the insurance industry starts sweating before breakfast. Hurricane Katrina barrels into Louisiana like a freight train with bad manners and no brakes. Within hours, levees surrounding New Orleans fail, turning one of America's most colorful cities into a watery grave. Nearly 80% of New Orleans disappears underwater, and suddenly insurance policies become bedtime reading. The storm leaves over 1,800 people dead and an economic disaster worth more than $125 billion. But another storm is quietly forming. This one isn't wind or water. It's insurance paperwork. More than 1.7 million insurance claims begin pouring in like the Mississippi River in spring. The insurance industry suddenly faces the largest catastrophe loss in modern history. Companies like State Farm, Allstate, and Nationwide brace for tens of billions in payouts. Even the seasoned bean counters in Ohio and Illinois start sweating through their suits. Insurers ultimately pay more than $40 billion in claims, and the argument over who pays what is just beginning. Because Katrina didn't just bring wind, it brought water, and that's where things get complicated. Most homeowners carried private insurance for wind damage. Floods, however, were another story entirely. Flood coverage came from the federal government through the National Flood Insurance Program. Suddenly, one question becomes worth billions of dollars. What destroyed the homes first? Was it the wind ripping apart walls like a cowboy saloon door in a bar fight? Or was it the floodwater quietly rising until houses floated like bad investments? The answer would decide whether private insurers paid the bill, or American taxpayers did. And that question would spark one of the biggest insurance battles in American history. Soon the Gulf Coast isn't just rebuilding homes. It's preparing for a decade of lawsuits. And two unlikely whistleblowers are about to light the fuse. In Biloxi, Mississippi, two sisters working as insurance adjusters begin noticing something strange in the claims files. Their names were Kerri Rigsby and Cori Rigsby, and they were about to become the most famous whistleblowers in insurance history. The sisters worked for a firm contracted by State Farm, the largest homeowner insurer along the Gulf Coast. Day after day, they reviewed damage reports from Katrina, and the pattern began to look suspicious. Homes clearly destroyed by wind were sometimes being labeled as flood losses. And that meant something very important in the world of insurance money. If wind destroyed the home, the private insurer paid. If water did it, Uncle Sam picked up the bill. The sisters believed some claims were quietly shifted from wind to flood, saving insurers billions. And when the Rigsby sisters decided to speak up, the insurance industry felt a storm coming again. By late 2005, the Gulf Coast isn't just rebuilding homes. It's rebuilding trust in the insurance industry. But thousands of homeowners say their claims are delayed, denied, or reduced to pocket change. Across Louisiana and Mississippi, lawsuits begin stacking up faster than sandbags before a hurricane. Lawyers realize Katrina isn't just a disaster story. It's about to become a courtroom saga. At the center of the storm sits one powerful company, State Farm. The company insured hundreds of thousands of homes along the Gulf Coast. And now those homes have become evidence in a massive financial battle. The Rigsby sisters bring their evidence to federal attorneys under the False Claims Act. Their allegation is explosive. Wind damage claims were sometimes shifted to flood coverage. If true, private insurers saved money while federal taxpayers paid the difference. State Farm strongly denies the accusations and prepares to fight in court. Meanwhile, another powerful figure steps into the storm, Mississippi Attorney General Jim Hood. Hood launches investigations into several insurance companies operating along the Gulf Coast. Thousands of homeowners have filed complaints with state regulators. The Mississippi Insurance Department, begins reviewing claim disputes across the state. Insurance Commissioner George Dale now faces a political and financial hurricane of his own. Public anger grows as families wait months for answers. And in towns from Biloxi to New Orleans, trust in insurers begins to crumble. By 2006, courtrooms across the Gulf Coast are packed with Katrina insurance cases. Some cases settle quietly, while others drag through years of appeals. The legal battle becomes one of the largest insurance disputes in U.S. history, and the financial pressure begins spreading far beyond the Gulf Coast. Reinsurance companies, the insurers of insurers, suddenly face massive losses. Across the global insurance market, Katrina has changed the rules of the game. Soon insurers begin raising premiums across coastal America. Hurricane coverage becomes more expensive than a steak dinner in a Texas oil town. Some insurers reduce coverage or leave high-risk areas entirely. The Gulf Coast now faces a new crisis, rebuilding homes without affordable insurance. And the insurance industry quietly begins rewriting the mathematics of disaster. Because after Katrina, everyone finally understands one thing: storms can bankrupt more than houses. By 2006, the insurance industry begins asking an uncomfortable question. How did Katrina catch the entire system so unprepared? For decades, catastrophe models predicted hurricanes, but many underestimated storm surge risks. And almost nobody expected levee failures to flood an entire American city. The disaster exposes weaknesses in the models used by companies like State Farm and Allstate. Billions of dollars in losses force insurers to rethink how risk is calculated. Even global reinsurers, the companies backing insurance companies, feel the shock. Reinsurance prices surged dramatically in early 2006. Some premiums jumped nearly 70% almost overnight. And suddenly living near the coast becomes a much more expensive lifestyle choice. Insurance companies now pour money into new catastrophe modeling technology. Meteorologists, engineers, and economists suddenly find themselves working on the same problem. How do you insure a disaster that might bankrupt the insurer? Meanwhile, along the Gulf Coast, rebuilding continues slowly. But thousands of homeowners remain locked in insurance disputes. Some cases drag through courts for nearly a decade. The Rigsby sisters' whistleblower case becomes one of the most famous. Years later, a federal jury rules against State Farm in a False Claims Act case. The case confirms just how complex Katrina's insurance battles have become. But Katrina leaves a deeper mark on the global insurance industry. Companies begin redesigning policies, pricing, and risk models. Governments also strengthen building codes across hurricane-prone regions. For coastal cities, disaster planning becomes a financial survival strategy. Yet for many families, the storm's financial scars never fully heal. Trust in insurers takes years to rebuild across the region. Because Katrina-proof disasters don't just test cities. They test financial systems too. The storm exposed a fragile line between natural catastrophe and financial catastrophe. And when that line breaks, the cost spreads far beyond the storm. From homeowners to insurers to taxpayers, everyone ends up sharing the bill. And that may be Katrina's most expensive lesson. Hurricane Katrina didn't just flood New Orleans. It flooded the entire insurance system.